Betsy Graseck, Morgan Stanley, Global Head of Banks and Diversified Finance Research, joining us now. Betsy, thanks very much indeed for your time. Look, for the last few quarters, it's all been about trading. Trading looks like it could be fading here, but I'm wondering whether M&A SPACs are going to kind of fill the gap that has been left by trading in this quarter.
Thanks so much, Guy, for having me on. When we think about the outlook for 1Q, when we started the year, we came in with an expectation that trading would be down year on year. But we actually have flipped that, and our forecasts are looking for trading to be up 1Q year on year in the 10 to 15% range. That is in part a function of the very active environment that we have in the equity market regarding IPOs and SPACs, et cetera. And then you also have the benefit of those activities impacting the investment banking lines as well.
So, Betsy, does that continue, though? Because not only are there signs that the SPAC feelings are cooling a little bit, but then if you do see leverage reined in or banks taking a look at their books because they are Archegos situation, what do you think happens the rest of the year?
So as it relates to our forecast going forward, we are anticipating that we're going to follow a traditional kind of seasonal pattern, which is that trading is the strongest in 1Q. And that fades as you go through the year. So, that's what's baked into our estimates. When we think about, the year on year, we are anticipating that as we move throughout the year, we'll have some declines. So, we go back to what I was mentioning at the beginning, that at the beginning of the quarter, we were fully anticipating the full year was going to be year on year down. And now we're more in the flat range with 1Q being strong.
Comps are going to get harder, though, aren't they? As you've alluded to. From an investment point of view, how does this change the narrative around the banks?
So as it relates to investment point of view, trading is one piece of the overall pie. It's not the entirety by any stretch of the imagination. And when I think about my group and why I'm overweight U.S. large cap banks and consumer finance, it really hinges on three key things. One, credit is doing phenomenally well and likely to beat. Two, we anticipate that banks will increase their buybacks as you move through in particular, second half of the year. We've already heard from Corals that, if you pass the stress test, that's going to be, the outcome effectively. And then three, we have an outlook for loan growth to pick up starting in the back half of this year, but really into 2022. So when you're investing in the group with a 1-year forward time horizon, you've got an outlook for better credit, more efficient balance sheet, and the beginning of green shoots in lending. Those things are really the major drivers of why we're overweight.
So let's just talk about the loans for a second. What's going to be the driver in the back half of the year?
So this year, back half is really a function of consumer spending on travel. C&I lending, not so much, right? C&I lending is going to be flat to down this year because of the PPP. There's a lot of technical issues around that, which we can get into if you want, but it's kind of technical. So really it's more about 2022 C&I picking up. Now, the fundamentals of C&I, there are needs, inventory management, inventory capital, cash workflow for manufacturing is actually increasing. And at the same time, if we get this infrastructure bill, you're going to see more demand coming from a much broader range of needs. But really that's a full-on 2022 impact.
Given what you just said, can I assume that peak deposits are almost in now and will fade from here?
No way. Okay, why do I say that? Because we know we are going to have a significant increase in deposits in the first quarter. You can see it in the H8 data, it comes out weekly. It's up something like, in the mid-teens or so. That is coming particularly from stimulus. That said, the Fed is still engaged in QE, quantitative easing. Quantitative easing is a direct injection of deposits into the banking system. So when we think about what the outlook is for bank reserves at the Fed, which is one way of thinking about what the deposits are going to be growing, this year we're looking for $2 trillion increase bank reserves at the Fed. Last year was $1.5 trillion. Next year we're looking for $1 trillion because we've got QE actually ending the end of next year at half the pace of this year. So you put that all together, we're still going to be seeing deposit growth. Now, your point might be, well, what are you going to do with it? And really today, we're sitting with a loan to deposit ratio of 50% or roughly. At some of my banks I cover, it's around 60-ish, mid 60s for the industry overall. We're hovering at near 50-year lows on that. So we are flush with deposits. Banks are very interested in lending, and loan demand picks up. There's definitely room to feed that loan demand. We're waiting for that to come through.
Hey, Betsy, before we let you go, I know you cover a lot of consumer banks, and also when it comes to the big banks. What's your favorite top pick?
So we have three going into the quarter. It's Synchrony Financial, Capital One, and then also, well, those are the top two. Why don't we just leave it at that? And the main reason is excess capital plus excess reserves as a percentage of market cap are extremely high, in the 20% range. And we think that as people realize credit cycle is going to be very muted, you're going to see lower losses, more reserve release, and increased buybacks. And that's the main reason why we are above the street, in particular on those two names.
Betsy, one final quick one from me. Wall Street is under pressure to treat its people, its junior people, better. What is going to be the impact of that, both in terms of costs, job retention, and culture, do you think?
Okay, well, this is really a question, I suppose, for my C-suite. But what I would highlight is that my own personal view is that I don't think that would be something that would be so significant of a cost, frankly, that would force me to change my expense line, right? I mean, from where I look at an expense ratio perspective, I don't think that would be something that would drive a change in our view on that.